نرحب في المستشار البريطاني ديفيد جيل. David Gill, it's a managing director for Sant Innovation Center in UK. The Sant Innovation Center, one of the leading innovation centers through the world. And based on my knowledge, it's the first innovation center in the Europe. David Gill has deep experience in innovations, ecosystems, and also entrepreneur ecosystem. And he will introduce today our lectures will be about finance for entrepreneurs, and he will taking us in a very good journey about the entrepreneurs. Mr. David, you can start now.
Dr. Hanadi, thank you very much for the kind introduction, and ladies and gentlemen, good evening. I hope over the next 20 minutes to cover with you an introduction to finance for entrepreneurs. So we won't be looking at the detailed products today, but looking at the general principles, and particularly how finance for entrepreneurs differs from finance that might be available to established firms and the mechanics of achieving it. And if I move us on to our first slide to give a little bit of a context to tonight's talk, I'm very grateful to Dr. Hanadi for having translated the slides into Arabic, because I'm sure it will make it a lot easier. The key lesson, I think, for all of us when we're looking to raise external funding for a new business, particularly one which has high growth potential, is identify exactly at what stage of development and what stage of risk are we at the moment, because that will dictate what the appropriate source of funding is. In the really early stages, which is where most startups and scale-ups in accelerators and incubation centers in high growth ecosystems will find themselves, the likelihood is that the funding that you will need will be a combination of equity, and I'll talk a little bit more in a moment about what that means, and grants, or non-dilutive finance as it's sometimes called, which would usually come from a government agency such as the Ministry of Science or the Ministry of Education, that has an interest in seeing the area in which you are developing your business grow larger for the benefit of the economy at large, so not just for your business. And that's why in many countries that have been growing an innovation ecosystem, it's been so important for government to invest in things like seed funds, in hybrid funds, in encouraging angel investors, which I'll also talk a bit about in a moment more in detail. It's only once you've got not just regular sales, but fairly predictable profits, that you would be a business that is suitable to get investment from organizations like banks, organizations that provide debt funding as opposed to equity funding. And I think particularly in the world into which we've moved with the COVID pandemic, it's quite likely that being able to list on a stock market is something which will take a lot longer now than it might have taken this time last year. We had seen in 2017, 18 into 19, something of a boom market materializing with companies that were still quite young, companies that still hadn't got much by way of profitability or other trading track record being able to achieve an IPO. Possibly that was already retreating before COVID, but in the post-COVID world, it really has gone down quite remarkably. And if I move this on to where I think we are, it's almost as if we've gone back to the normal of how things would have been in 5, 6, 7 years ago, as opposed to how things were 2 or 3 years ago. What investors will be looking for from most early stage companies is, are people prepared to buy your product for money or your service for money? It's gone back to what the people who founded one of the most famous accelerators of all, Y Combinator, used to talk about. The key thing you need to do is to build something that people want and build something that people will pay for. So the most important source of funding, both when you're trying to prove yourself to investors and longer term for the sustainability of your business, is going to be the funding that comes in from clients, from people who buy your product. The next fundamental issue, I think, for all early stage entrepreneurs is to try to take a view of what sort of company do you want to be over the medium to longer term. And as most of you probably know, the great majority of companies that are started up across the world are companies which don't have particularly high growth ambitions. They tend to be companies which are providing something of a lifestyle for the founders. It could be that the 3-4 people who started it are very happy just to run a trading company, a company which will rely only on their talents and on the time that they've got available, and therefore it won't scale significantly beyond the amount of time that they can make available to their business. The classic of that, one which will have a solid return probably to many of the founders, would be a consulting firm, one where you're selling expertise. It could be something specific in management consulting, it could be in law, it could be in accountancy, but realistically, your level of growth, your level of profitability depends on the number of people in the firm. And as the old saying has it, your assets leave the building every evening. Now, at the moment, we're in a slightly different way of doing business, but it's still true that with a consulting firm, the extent to which you can grow will almost certainly be limited by the number of high quality people that you can recruit into the business. On the other hand, if you have spun your business out of a research base and you have some new technology which you can develop not just into one product, but into a platform or a suite of products, which would have many different applications over the medium term, so that people who have bought your software, let's say, and installed it, and have to pay you a royalty over the course of the year, they are enabling you to make an income even when you're not in your laboratory or in your office. And it's firms like that that have a huge upside. Generally speaking, however, companies like that will require a lot of investment in the first 5, 6, 7 years of their existence to build out their products, to build out their capacity, to build out the whole supply chain that supports them so that they can get to the stage where they get that hyper growth. And that's where the external investment is needed. Something which, if you've already raised money for a startup in the past, will probably seem pretty much self-evident to you, is the big difference between people who lend money to you and people who invest money in your business and take a share in the long-term ownership, and probably won't part company with you until the business is sold or floated on a stock exchange. And a lot of the problems that we encounter in the Innovation Centre with first-time entrepreneurs is we have to say to them, look, on the whole, banks are not suitable for you because you are too risky, you haven't proven your business model, you haven't proven that people are prepared to buy your product. And so what you really should be doing is relying on equity investors, people who want to share the journey, share the risk, and also share the upside with you. And it's for those reasons that over the past 20 or 30 years in many developed countries, there has been such an emphasis on building up a venture capital sector and an angel investment sector. And to put that in context, although often what you read in the newspapers has got what statisticians call a survivor bias, in other words, if you're reading about companies like Facebook or Alphabet or Uber, you're reading about the success stories, you're reading about the companies in the portfolio of the venture fund that produced a very high return. In reality, most long-term investors in the equity space, particularly in technology companies, know that on average, in the first few years of their fund, at least 3 out of 10 companies will fail. And another 4 or 5 will be what's sometimes called the walking wounded or the living dead. In other words, companies that aren't growing particularly fast, that don't justify further investment, that are unlikely to provide an exit for the investors. but on the other hand, you can't wind them up. So they are the worst sort of company to have in your portfolio. You've still got to look after them from an administrative point of view. You can't write off the investment from a tax point of view, but you're never really going to get any return from them. And what will dictate whether a fund is a success or not is whether it has 1, 2, or 3 star performing companies in its portfolio. And we'll talk in a moment about what a star is. Because if you have one company that, let's say, returns 10 times the money you put in the fund, that one company alone will pay off the entire fund, even if everything else makes losses. If you have 2-star companies, you as a fund manager, as a venture fund investor, begin to look as if you've got above average performance. And if you have 3 companies that each return 10 times or more the initial investment, then the people who invested in your fund like you a great deal and will consider investing in your next fund.